There's a number doing the rounds in Westminster right now, £1.5 million. And if your home is worth anywhere near that figure, this number could end up costing you thousands of pounds every single year for the rest of your life. Now, before you switch off and think, well, that's nothing to do with me, I don't live in a mansion, let me tell you who is actually most exposed here. It isn't oligarchs, it isn't footballers. In an awful lot of cases, it's retired people who bought a perfectly ordinary house on a perfectly ordinary street 30 or 40 years ago and simply never moved. On paper, they look rich. In their bank account, they're anything but. Andy Burnham became Prime Minister on the 20th of July. He's been in the job less than a month. And in that time, 3 separate things have landed on anyone who owns property in this country. One of them is a rumour. One of them is already law, and almost nobody's talking about it. And one of them quietly expired 16 days ago, which has left a lot of landlords in a far worse position than they realise. And I want to be straight with you from the very start, because there's a great deal of noise online at the moment and not a lot of accuracy. Some of what you're about to hear is confirmed law, already passed, already dated. Some of it is speculation printed in a Sunday newspaper. I'll tell you clearly which is which as we go along, because that difference matters enormously when you're deciding what to actually do about it. I'll also tell you which of the 3 I think really matters. And I'll warn you now, it is not the one making the headlines. Quick one, before we get into it. There's money people over 60 are entitled to every year and never claim. I've put every allowance, every claim, and every strategy into one book. What HMRC won't tell you. Links in the description. Right, let's start with the headline, because that's the one everybody's asking about. The so-called mansion tax is real. It exists. It's law. Its proper name is the High Value Council Tax Surcharge, and it was announced by Rachel Reeves in the budget on the 26th of November last year. From April 2028, if you own a residential property in England worth £2 million or more, you'll pay an extra annual charge on top of your normal council tax. It starts at £2,500 a year for homes between £2 million and £2.5 million, and it rises to £7,500 a year at the top end. The Treasury expects it to bring in around £430 million a year by 2029-30. So that's the confirmed part. Here's the speculation. The Mail, on Sunday, reported that Andy Burnham is looking at pulling that entry point down from 2 million to 1.5 million. His office has not confirmed it. But, and this is the important bit, his office has not ruled it out either. They were asked directly, and they didn't say no. Now, why does 500,000 matter so much on a number that big? Because of where the houses actually are. The think tank Tax Policy Associates ran the figures. A 1.5 million threshold would drag in roughly 150,000 extra homes, almost doubling the number caught. In the east of England alone, you'd go from about 9,200 properties to nearly 24,000. These are not palaces. These are 4-bedroom houses in commuter towns. But here's the part almost nobody has picked up on, and it changed how I think about this whole thing. Simply adding a cheaper band at 1.5 million doesn't raise very much on its own. It's small change to the Treasury. So to make it worth doing, a government would have to charge those homes the full 2,500 and push up every band above them as well. On that basis, the same analysis puts the take at around £800 million a year, roughly double what this tax was ever designed to collect. So the threshold is the headline, but the rates are where the real money is. And rates are far easier to change, because changing a rate needs no new valuations and no angry front pages. It's one line in a budget speech. And that matters even if your home is worth £400,000, because a tax like this establishes a principle that the taxman can charge you every year based on what an asset is worth, rather than on what you earn. Once that machinery exists, it can be widened. Look at what happened to stamp duty over 30 years. And it's already moving the market. Sales of London homes worth 2 million or more fell by nearly a fifth in the first half of this year compared with the same period in 2025. Homes over 5 million were down about 15%. Buying agents now factor this charge into offers on homes as low as £1.25 million. One described offering £1 under £2 million on a Kensington flat and simply blaming the government. Now hold that thought, because the mansion tax is the thing everybody's shouting about, and it doesn't come in until 2028. The next one arrives sooner, it's already law, it can't be lobbied away, and it will hit vastly more people. From the 6th of April 2027, rental income in this country gets its own separate set of income tax rates. Not the normal ones, its own ones. 22% at the basic rate, 42% at the higher rate, and 47% at the top. That's 2 percentage points more than everybody else pays on wages or on a pension. This is not a rumour. It was legislated in the Finance Act 2026, which got royal assent on the 18th of March. It's done. HMRC's own estimate is that around 2.4 million landlords will pay more as a result, roughly 6% of everyone who pays tax in Britain. And the reasoning is quite clever, in a slightly infuriating way. Employees pay national insurance. Landlords don't pay it on rent. So adding 2 points closes that gap without technically breaking a promise not to raise income tax. They didn't raise a rate, they invented a new one. On modest numbers, it looks small. £10,000 of rental profit at basic rate costs you £200 more a year. £20,000 at higher rate, £400 more. Annoying, but hardly the end of the world. Except there's a second change buried underneath it that got almost no coverage at all. And for a lot of people watching this, it will cost more than the headline rate does. At the moment, your personal allowance, the first £12,500 you can earn tax-free, gets allocated in whatever way produces the best result for you. That's the current rule. From 2027-28, that stops. The personal allowance will be set against your employment income, your trading income, and your pension income first, which means it gets used up on the income taxed at 20, 40, and 45, and your rental income, the stuff taxed at 22, 42, and 47, goes to the back of the queue. Think about who that hits hardest. Somebody with a state pension, a small private pension, and one rental property. Their allowance gets soaked up by the pension, and the rent is taxed at the higher rate from the very first pound. That's not a headline anywhere, it's an ordering rule, and it will quietly cost some people hundreds a year. One small mercy: if you own personally with a mortgage, that basic rate tax reduction you get instead of proper interest relief will be calculated at 22% rather than 20%. Slightly better for you. I'd rather give you the whole picture than just the frightening half of it. Now, the third thing. And this one has a deadline attached that has already gone. Section 21, the so-called no-fault eviction, was abolished on the 1st of May under the Renters' Rights Act. If you served a valid one before that date and your tenant hadn't left, you had a short transition window to get a claim into court. That window closed on the 31st of July, 16 days ago as I'm recording this. And I need to be precise here, because there's a lot of bad information out there. The test wasn't serving the notice, it was asking the court to issue the claim by that date. If you missed it, that notice is worth nothing. You start again from scratch under Section 8, and you have to prove a legal ground. And it gets sharper than that. If a landlord tries to serve a Section 21 notice now, out of habit or because they've been given old advice, it isn't just invalid. The local authority can hit them with a civil penalty of up to £7,000 for a single breach. £7,000 for posting the wrong form. Under Section 8, there's a new form, Form 3A, and revised grounds. You can still get your property back to sell it, or to move yourself or close family in, or for serious arrears. But you have to evidence it. Paperwork you never needed before is now the whole ballgame. The rent rules changed at the same time, and that's been badly underreported. Rent can only go up once a year now, only through the formal Section 13 process, with 2 months' notice instead of 1. Any rent review clause in an old agreement became void on the 1st of May, and tenants can challenge the increase at the tribunal. Here's the bit that changes the maths. The tribunal cannot set the rent higher than the landlord asked for, and it cannot backdate it. So challenging is essentially free. No downside risk. One industry survey found 22% of tenants intended to appeal regardless of whether they thought the rise was fair. You also can't take more than 1 month's rent in advance anymore, which quietly removes the main way a self-employed tenant used to reassure a nervous landlord. Now, if these changes are hard to keep track of, that's exactly why this channel exists. Every week I break down what's actually changed and what it means for your money, in plain English, without the shouting. Around 3/4 of the people watching this aren't subscribed. If you find this useful, it genuinely helps if you do, because there's more coming. From late this year, landlords must register themselves and every property on a new private rented sector database, and that registration becomes a condition of even seeking possession. A landlord ombudsman follows, expected to be compulsory by 2028. Then a decent home standard for private rentals. The Act rolls out in stages, and the final one isn't until 2035. So what does all of this tell us about the man now running the country? His record is public, and it's consistent. As Mayor of Greater Manchester, he set up the Good Landlord Charter. It's voluntary, and to be fair, it's not a stick. Over 100 landlords signed up, covering more than 234,000 homes, roughly half of everybody renting in the region, and supporters can access grants of up to £30,000 for energy efficiency. That's a genuine carrot, and it deserves saying. But it ran alongside a crackdown. Enforcement fines for housing offences there rose 43%, totalling £1.47 million over 2 years, reinvested straight back into more enforcement, and 26 extra enforcement officers were funded. He's also spoken about a 3 warnings approach for the worst landlords in shared housing, backed by councils using compulsory purchase powers. He also said something as mayor that tells you more than any policy document. He said he believed work was overtaxed and assets were undertaxed. Hold that sentence in your head when the budget arrives. And that budget is Wednesday, the 28th of October. John Healey's first as Chancellor. Burnham has already ruled out scrapping council tax and stamp duty this year, which killed off the wilder summer speculation. But he pointedly did not rule out the mansion tax threshold moving, and capital gains tax is being talked about constantly. So what do you actually do? First, and I mean this seriously, don't restructure anything on the strength of a newspaper report. Moving a property into a company can trigger capital gains tax, stamp duty with the surcharge on top, legal fees, and a new mortgage at company rates. People who did that in a panic before a previous budget are still counting the cost. Second, the one almost nobody mentions. This tax year and next, rental profits are taxed at 20, 40 and 45. From April 2027, 22, 42 and 47. Which means a deductible cost is worth more to you after that date than before it. If you've a big repair coming, that timing is worth a conversation with your accountant. It's not avoidance. It's knowing which year the relief is worth more in. Third, if you own property personally and you're on a pension, get someone to model that personal allowance change before it lands, not after. And fourth, records. Under Section 8, you have to prove things. Certificates, inspections, correspondence, deposit protection, the lot. The landlords who come unstuck now aren't the villains. They're the ones whose paperwork drifted. So, to bring it together, the mansion tax at £1.5 million is still speculation. The property income tax rates from April 2027 are law. Section 21 is gone, and the transition deadline has passed. And the direction of travel is about as clear as these things get. When a government needs money, it looks at what people own, because what people own can't move abroad and can't argue back. Don't judge any single one of these on its own. Judge the pattern. If this was useful, share it with someone who owns a property. And if you want this sort of thing explained without the jargon and without the political shouting, subscribe. Thanks for watching, and I'll see you in the next one.